Hello, I'm Lou Kerner, the founder of Crypto Mondays, and thanks for attending today's webinar on the right strategy for strategy. Um, Brought to you by Crypto Mondays Institutional, or now we're calling it CM Institutional, one of our three sub-brands I'll talk about briefly in a little bit. And I'm super excited to have three of the smartest guys I know, uh, from the analysts on strategy to help us all understand strategy a little bit better. I'll be handing it over to them shortly. But in the meantime, we started Crypto Mondays as a meetup originally on January 8th, 2018. And, just to get together with other crypto enthusiasts. Today, we're the largest IRL community in Web3 with chapters in 54 active chapters around the world. It started in New York City, which has more than 25,000 attendees over the years. The fifth one that started was Crypto Monday Paris. That became Paris Blockchain Week. And the 54th and 55th actually are starting on the 20th in Fort Myers and Medellin, which I think is going to be a great one to go visit. Um, I mentioned the three sub-brands that we started. We started Bitcoin Mondays and Crypto Monday Wall Street, which is now evolved as we bring it outside into Crypto Monday Institutional. And as I mentioned before, we're a community, and so I'd like to highlight three of the community members, running these subgroups, who are really making it happen. Jesus Najera runs Bitcoin Mondays, and he also runs SetDev, which is a super successful Bitcoin dev shop. In addition to having a wallet for SMBs to do treasury management and other things that they do for the Bitcoin community. So he's an awesome guy to have, focused on Bitcoin Mondays, which happens on the third Monday in New York at PubKey. Joe Cox has been running Crypto Mondays Wall Street for the last year and a half, and they've been crushing it with Julie Lam. So shout out to them. And David Fung has been running this sub brand what we've been calling Crypto Monday Classic. He'll continue to do that. That's the fourth and fifth Mondays of the month in New York. And he's also going to be taking responsibility for helping bring Crypto Monday Institutional around the world outside of Wall Street and at major events like Money 2020 in Vegas. We do a couple other things at Crypto Mondays as well. We have a community management AI agent that's now in beta called Agent Monday, and that's to help our community members learn and connect better, help our organizers better, and to get better ROI for our sponsors. So it's very exciting being on the cutting edge of all of that. And we started building this late 24, realized there were tons of problems we weren't going to solve. So we started the Decentralized AI Agent Alliance, which now has 225 members helping to solve some of the problems in decentralized AI agents. With that, I'm excited to turn it over to our featured guest today. We'll start with Lance and then hand it off to Jeff, and we'll finish up to Mike before we turn it over to Q&A from the audience. I'll start with a few. If you have a question, just raise your hand and then open up your mic and your video, and you can ask them the questions yourselves. With that, I'm going to start sharing and turn it over to Lance.
Thanks. Thank you, Lou. Thank you for having me. Good afternoon, everyone. I'm Lance Vitanza, Managing Director in Equity Research at TD Cowen, where I lead our digital asset research effort. I have a few slides that I'm now going to attempt to screen share, so just give me 1 second here and see if I can do this. All right. Okay. All right. So hopefully you can see that. What's the right strategy for strategy? So let's just jump right in. Strategy Inc. When I first began looking at this company several years ago, I thought I was analyzing a software company with a very unusual treasury policy. Instead, I gradually came to believe I was watching the creation of an entirely new equity category. What began as a single company accumulating Bitcoin has evolved into a broader phenomenon that we now describe as digital asset treasuries or DATs. And today, public companies around the world are raising capital, accumulating Bitcoin, and increasingly organizing their capital structures around digital assets. To me, this is one of the most important developments occurring at the intersection of crypto and public markets. So before we get more into strategy, just a quick word about how I arrived at this topic. My background is entirely traditional finance. Prior to equity research, I spent 5 years in investment banking, primarily at Goldman Sachs, and have spent most of my professional career analyzing public companies through fairly conventional fundamental and valuation frameworks. So I did not arrive at Bitcoin as an early adopter or a crypto evangelist. Frankly, I arrived as a skeptic. The more work I did, however, the more difficult it became to dismiss Bitcoin as simply another speculative phenomenon. The key question for me was never whether Bitcoin's price could go up or down. The more interesting question was why an asset with fixed supply, growing institutional acceptance, and increasingly global ownership continued attracting capital despite repeated predictions of its demise. Eventually, my perspective shifted. I became convinced that Bitcoin deserved to be analyzed as a serious monetary asset. But what really captured my attention wasn't Bitcoin alone, it was strategy. Because strategy wasn't merely buying Bitcoin. The company was building a framework through which public market investors could potentially gain access to Bitcoin in a way that differed meaningfully from simply buying spot exposure. And that realization ultimately led us to a much broader research effort where we focus on Bitcoin treasury companies and digital asset treasuries across the spectrum. So most people understand the basic strategy story. The company raises capital and then they buy Bitcoin. What's more interesting is how it does so. The central insight in our research is that strategy should not be viewed simply as a Bitcoin holding company. It should be viewed as a capital markets innovation. At a high level, the model works as a flywheel. A premium valuation enables the company to raise capital. That capital can be deployed into additional Bitcoin acquisitions. To the extent those acquisitions increase Bitcoin ownership on a per share basis, shareholders benefit. If investors value that, the company can continue accessing capital on attractive terms, and on we go. Most people compare strategy to an ETF. We think that is an incomplete and ultimately misleading comparison. An ETF provides exposure to Bitcoin price. Strategy is attempting to grow Bitcoin ownership per share. Whether it succeeds in doing so is the key question for investors. In our work, we spend considerable time focusing on Bitcoin yield and related measures of Bitcoin accumulation per share, of which there are many. The reason is simple. A spot Bitcoin ETF gives investors exposure to Bitcoin. A successful Bitcoin treasury company, by definition, gives investors exposure to a growing amount of Bitcoin per share. And that is a very different proposition. What's fascinating is how strategy has continually expanded its capital markets toolkit. The company began simply with common equity, and then it moved to utilize convertible bonds, and then it introduced multiple preferred stock structures. Over this time, it demonstrated that investor demand existed for different forms of Bitcoin-linked exposure, which leads to what I view as the next chapter in the story, the advent of digital credit. If Bitcoin treasury equity was the first major innovation, then digital credit is surely the second. Much of the discussion around strategy still continues to focus on MSTR, the underlying common stock, but increasingly I find myself thinking about STRC or stretch and the broader preferred stock complex. Because these securities potentially expand the addressable market dramatically. Not every investor wants the volatility of common equity, and relatively few want direct Bitcoin exposure. But many investors are looking for income, they're looking for yield, they're looking for liquidity and credit-like instruments. And that is where digital credit enters the conversation. What strategy has begun to demonstrate is that a Bitcoin-heavy balance sheet can potentially support an entirely new class of securities designed for income-oriented investors. Importantly, strategy recently formalized what it calls its digital credit capital framework. Now, this is designed to strengthen its preferred securities, enhance liquidity, preserve long-term Bitcoin exposure, and support shareholder value. The framework includes a US dollar reserve policy, a revised stretch dividend policy, repurchase authorizations for both preferreds and common stock, and of course, a Bitcoin monetization program. The key takeaway for me is that Strategy is beginning to manage its preferred securities franchise much the way a sophisticated financial institution manages its liabilities through reserve management, dividend policy, repurchase flexibility, and liquidity support, while at the same time maintaining Bitcoin as its core reserve asset. So whether this becomes a major long-term market remains to be seen, but the concept itself is powerful. The first generation of Bitcoin treasury companies asked, can a public company accumulate Bitcoin and create shareholder value? Digital credit asks a different question. Can a Bitcoin heavy balance sheet support an entirely new ecosystem of yield oriented securities? And maybe even more importantly, can it attract entirely new categories of investors? Well, we've already seen evidence that the concept is spreading. Strive, for example, has issued its SATA preferred shares. They were modeled after Strategy's Stretch preferred shares, and they're designed to appeal to income-oriented investors seeking Bitcoin exposure with lower attendant volatility. Interestingly, Strive has also used Stretch as part of its own dividend reserve architecture, which illustrates how digital credit may become part of a broader Bitcoin-linked financial ecosystem rather than merely a strategy-specific or even a Strive-specific product. Looking forward, I think it's entirely reasonable to envision digital credit products emerging across multiple issuers, multiple jurisdictions, multiple currencies, and multiple investor segments. Other companies have already begun creating stretch derivative products which parse the risk even further. For example, a senior most tranche offering, say, 6% yield with near zero volatility, offset by a junior tranche that pays more than stretch, but with somewhat greater volatility. And I think this is particularly fascinating, and I'm looking forward to seeing how demand for these new financial products develop. So when I step back, and I'll wrap with this, my conclusion is that Strategy's greatest innovation isn't putting Bitcoin on a corporate balance sheet. It is building a capital markets architecture around Bitcoin. So with that, I will hand off. But again, Lou, thank you so much for including me here, and thanks everybody for joining. I look forward to the discussion that follows.
Wow, thanks so much, Lance. That was really terrific. There's a lot of new stuff there that I hadn't really considered, and I'm really looking forward to the Q&A. Thanks a lot for sticking around. And with that, I'll hand it over to Jeff.
Thanks, Lou, and good
Oh,
afternoon,
yeah, hold on
everyone.
a minute. You got to stop sharing if you can. I'll grab it and then I'll stop sharing. Okay, hold on just a moment. There you go.
And fantastic. Thanks, Lou, and thanks everyone for joining, and good afternoon. My name is Jeff Kendrick. I run digital asset research at Standard Chartered Bank, based out of the UK. Interestingly, I also came at this asset class many years ago, similar to Lance, somewhat. I'll probably use the word pragmatic as opposed to skeptical, but certainly in that direction. I came out of a traditional macro research around COVID, so about 6 or 7 years ago now, when I also then took on digital asset research. Our bank does not have an equity arm, so I'm not going to give any price predictions on MSTR, but I am always giving price predictions on Bitcoin, and it's fair to say that the two in the last few years, given Strategy now owns 4% of Bitcoin outstanding, have become interlinked, and we've seen a lot of that in the last few months in particular. So starting on Bitcoin, and therefore taking a slightly different angle than Lance took just now, my forecast is that we've seen the low in Bitcoin in this cycle. We've come down from 126K in October last year to 58, 59,000. I think it makes sense that the cycle is much shallower than it was in previous cycles, specifically due to the DATs like Strategy and due to the ETFs. Quite frankly, the 126K high on October 6 last year was also not very exciting. And so I suspect the low this year will be equally as unexciting, and therefore I suspect we've already seen it in the last few weeks. Going forward, I think it's reasonable to assume that the Bitcoin cycle theorists, the 4-year cycle theorists, will all be focused on early October as being the potential low in their opinion, because that will be 12 months after the high from the second half of 2025. And that's the same thing that happened in previous cycles, right? 12 months later. Because of that, and probably by then we will have already gone through the IPO summer, where IPO interest and capital has been taking eyeballs and money away from digital assets more broadly. But by then we should have also had the OpenAI IPO. Obviously, we had the SpaceX one a month or so ago. That saw reasonably large outflows from ETFs, where people were freeing up cash to then plug into the SpaceX IPO. But even on the ETFs that we saw sold at the time, overall, the ETF story has held up exceptionally well. Like in Jan-Feb this year, you could have made an argument that given the average ETF holder is at about 95K for Bitcoin, you could have seen significant capitulation, but we haven't really seen that. So that tells me that the ETF holders are structurally changing, as are the DATs, the market structure for Bitcoin, which is going from what was 100% retail to now a chunk being institutional, and therefore a less exciting top last year and a much less exciting bottom this year, in my view. On strategy directly, there was obviously some concern when they did the initial sale recently of 32 Bitcoin. Obviously, they did another 3,500 2 weeks ago, but the 32 really threw the market off. And the reason I think it did throw the market off, both for MSTR, for Stretch, and for Bitcoin, so I think all three, quite frankly, right now are linked, is that there's a communication challenge for strategy today. So when you spend 5 or 6 years telling everyone that you'll never sell your Bitcoin, better off selling your grandmother or your kidney than selling your Bitcoin, it's extremely difficult to change that narrative, particularly when a large amount of this asset class is still dominated by retail. But I think that's what strategy are trying to do today. Yeah, so it made a lot of sense from 2020 up until, quite frankly, the back end of last year, that mostly strategy was a Bitcoin accumulation vehicle. When MNAV was high, as Lance was speaking about a moment ago, you could add relatively easily Bitcoin per share, right? Just by tapping the ATM and raising cash with common equities initially and then other forms later on. But it was relatively easy when the MNAV was high. Now today, anyone that goes on the strategy website can see that the MNAV is almost bang on 1, right? i.e. there's no extra premium inbuilt in the MSTR share price today. Now, if that's the case, and if we assume that remains relatively the case going forward, then strategy needs to have a different purpose. And that's where the credit products have come in, particularly over the last 2 months, but also partly before that. And specifically, Saylor is trying to turn strategy into an asset holder of 50 billion odd dollars worth of Bitcoin today, where that is used specifically as collateral for Stretch mostly today, but also the other credit products. Now, again, that's a very difficult narrative to change, but I think that's what has happened in the last couple of months, both with the detail of the dollar reserve and other that Lance mentioned before, but also with the 2 sales of 32 Bitcoin and then the 3,500 Bitcoin from a couple of weeks ago. Specifically, where I think this ends up is that at some point in the future, investors will understand that MSTR is no longer a Bitcoin accumulation vehicle, but rather it's a stockpile of collateral, which is used for the credit product. And when that happens, quite frankly, MSTR will no longer need to sell its Bitcoin. I use an analogy here like what central bankers do sometimes. So I'm sat in the UK. About 10 years ago, the ECB, then President Mario Draghi, said, we'll do whatever it takes to bail out the European debt crisis. In the analogy here with strategy, at some point, it'll be understood that Saylor will do whatever it takes to back Stretch. And when that happens, you'll see STRC price head back towards 100. And quite frankly, when that happens, there'll be no need to sell any more Bitcoin once the market understands what they're trying to do. Yeah. So for me, I'm putting all of this noise down as a communication issue. It's difficult, once again, and I'll finish on this, to go from never sell your Bitcoin, prefer to sell your grandmother, to we will sell Bitcoin if needed to back up this credit vehicle. And so I think at some stage soon, investors will get that. And quite frankly, then the pain in Stretch, the pain in MSTR, and the pain in Bitcoin will probably go away, confirming my view that Bitcoin has based. And I suspect we go back to 100K in Bitcoin by the end of this year. Thanks, Lou.
Okay, thanks again, Jeff. Again, very, very informative. Just real quick, do you have a story that you favored, the old one or the new one?
Well, I mean, it's completely different, right? So
Yeah,
now,
I had not really thought of it. And as Lance mentioned, it's obviously this evolution.
yeah, completely different. I mean, look, if you had an MNAV of 2 or 3, which was 2024, that was a pretty easy business model. That's like the best business going around. You borrow or you sell
Yes,
equity, you sell $100 million of equity, and the value of your company goes up $200 million. I'll take that every single day of the week.
I'd like to
Um,
be that company's banker.
well, well, quite, yes. But I suspect actually going forward, the opening up of the credit vehicles on the back of digital assets more broadly is going to be a huge space. So we've seen others like Coinbase, Morpho, there's other link ups, but obviously in scale so far, it's really what Saylor's trying to do with strategy.
Okay, terrific. Thanks again, Jeff, and thanks for sticking around. And now let's hear from Michael.
Hi, Lou. Thanks for having me on the podcast, and it's a pleasure to be here with you, Lance, and Jeff. Um, for the record, I love Bitcoin, but if I had to choose between Bitcoin and my grandma, I would choose my grandma. Um,
Good to know.
yeah, just putting that out there in case you know, other family members listen to this. But my name's Mike Treidel. I'm founder and CIO of Blue Coin Capital. It's a long only, fundamentally driven crypto hedge fund that I launched in January 2015. After 20 years in institutional finance, working at Morgan Stanley and Capital Group, we invest in crypto tokens as well as crypto equities with a focus on DeFi. It's institutional grade, real custody, real audits. The thing I'd like to highlight about the firm is that it charges 20% performance fee, but only on the performance above a benchmark. So you pay for actual skill, and that discipline shapes how we invest. Me personally, as I mentioned, over almost 20 years of experience, Fannie Mae, Morgan Stanley, Capital Group. I was there during the subprime crisis, there during COVID, and I fell down the crypto rabbit hole in 2017. So I'd like to share something. Just want to do it here real quick.
And just, I'm sorry, Michael,
Yeah.
give me a moment. I should have said this earlier, but the kind of the genesis of this call was I read, I think it was a tweet, a long tweet that you wrote. And I'm a former Wall Street analyst as well, and obviously there's a lot of stuff to read on Twitter, and the vast, vast, vast majority of it is drivel. But I read Michael's, and wow, really found it to be, really thoughtful. Um,
Great.
here we are.
And let me see if I can share the link in the chat just in case if people want it there.
Can you make it full
So
screen, or is that as full screen, I guess, as it gets?
yeah, let me see if I can. It says I'm sharing the screen.
Because it seems like there's something that you can press on. Yeah, yeah, yeah. Yeah, in any case.
Okay. Hopefully, or I shared the link too. So if you want to see the full thing, is it for me? It's taking up the entire screen. How is
Yeah.
it for everyone
Well, we
else?
can just see a bunch of stuff like 3 rows above it, in your browser.
Right.
But
Yeah. Yeah. Not sure how to share just the browser itself.
I think just to the right of looks, I think it looks like the thing that you can click on. Oh, no. Yeah, that's fuller.
Oh, okay, great.
Great, thanks.
Um, yeah, no problem. Can you still see it?
Yeah.
Okay, great. So, um, yeah, so like I said, I've been in crypto since 2017. I had heard about strategy for quite a while. This whole idea of a flywheel and buying more Bitcoin, it just sounded like a Ponzi scam to me. And then as you do in running a fund, you look for different levers to pull and different ways to get leverage. And that's what interested me in strategy. So I started digging, doing more research. And when I looked into actually how the flywheel works, I realized it's not a Ponzi scheme. It's actually a very intelligently, creatively constructed capital markets tool. And in the process of teaching myself, I put together this Substack that could potentially teach others. And so basically, the flywheel, the gist of it is, as long as the share price trades at a premium to the NAV, the underlying Bitcoin, right? It becomes accretive to issue new shares and buy more Bitcoin. But the key is, of course, that it needs to trade at a premium. Um, why would it trade at a premium? And that's sort of the question. Right now, as you can see on Strategy's website, the MNAV is pretty much one, and that's the enterprise value MNAV. So it's not currently accretive to issue. On here, I also include a numerical example, just so you can actually walk through the math and see how the Bitcoin per share might start out at 0.001 Bitcoin per share and end up at 0.01045. So the math works out, and it is actually accretive. But it's again, it's based on the premium, trading at a premium. And I guess I can jump down here to why would it command a premium, right? I think that's important. And part of it is looking at the landscape of leverage. And again, I'm going to try not to repeat more of what's said and be mindful of time. And this is how I came to understand strategy. It's a very unique product in terms of leverage, right? Many, fund managers, investment professionals, we're always looking for different ways to get leverage. There's leveraged Bitcoin's ETFs. There's perps or perpetual futures. There's regulated Bitcoin futures on the CME, or you can just do margin borrowing. But all of these have different costs. One major drawback with a lot of these methods is margin calls, right? And as we all know, Bitcoin's extremely volatile. And if it drops 20, 30%, you could be in trouble. And no one wants to have to delever at the bottom of a market. So the key with strategy is that it provides leverage without a margin call. Originally, its initial thesis was, hey, we have access to Bitcoin, but then the Bitcoin ETFs came out. And as a result, its premium potential has gone down over time, but it still commands a decent premium. Firstly, because it's margin call free compared to a lot of different leverage options out there. And also its competition, which I think was touched upon briefly. There's two other big competitors. A lot of DATs were launched last year around this time. Unfortunately, they were launched at the peak of the market, and it's hard to, it's hard to do a DAT when prices are falling. So there's really within the U.S. for U.S. investors, so excluding MetaPlanet or any others, for Bitcoin, there's really two other competitors. And if you just look at the numbers here, right? Bitcoin held strategy over 840,000 Bitcoins. That's multiples bigger than either 21 Capital or Strive. And then that's also reflected in the market cap and the launch date, right? Strategy was launched in 2020. It's been through these kind of cycles before, whereas the other DATs have not. So as with ETFs, scale is moat, right? And that moat translates to premium. If you look at the premium, right, over time, and I did two different premiums. One is the enterprise value, which is quoted on Strategy website. The other is net of senior claims. It's pretty much the same calculation, but you take the debt and the preferreds and you switch it from the numerator to the denominator. So it's a different way of looking at it. It comes out to somewhat similar numbers, but a little bit different. And if you look at the premium over time, actually, you can't see it on this chart, but in the past, it got as high as 4x. And it's come down over the long run. Right now, it's like I said earlier, it's currently at 1. I don't think it's going to sit there for very long. And with strategy, it creates a very attractive entry point when it's close to one, because not only do you get leverage exposure to Bitcoin, but
Well, just I assume you say it's not going to. You assume it's going to go up. I assume,
yeah, I mean, I,
or not. I'm just, but
yeah, I
when you say
think,
it's not going to sit there for long, are you implying that it is going to go up? Or
I think the probability is higher that it goes up than it goes down, if that makes sense.
yeah,
And after doing this entire, I'll just wrap it up here really quick. After doing this entire analysis, I think the key takeaway is it's fine in terms of its situation. It's not gonna go bankrupt. It's not gonna implode. It's very well constructed. It's got $3 billion of USD reserve. It's really just a bet on leverage Bitcoin. So if Bitcoin can continue to increase in price over the long run, strategy will do very well. It doesn't create problems if Bitcoin drops down to 30K. That's totally fine for Bitcoin as long as it doesn't sit there for 2 to 3 years. It's really the long run growth that's necessary to fuel the premium and to fuel strategy. So as long as Bitcoin over the long run can continue to grow, that's what'll give it the fuel. And an interesting note is that there really aren't any other commodities like this, right? Like you can't create this kind of investment vehicle for equities due to regulations and such, and you can't really do it for other commodities like you know soybeans or pork belly or whatever, because they tend to just trade sideways. And so Bitcoin has created this unique opportunity that's been seized upon in creating strategy and then some of its competitors. I'll take a minute just to talk about Stretch really quick before wrapping it up.
okay, yeah. If you can be quick, because it's
Yeah,
time to it's Q&A time.
right. So basically, I think also Stretch is in a good position. Um, it can hurt and it can also help the common shareholder. It provides leverage, which again jumpstarts the flywheel. The flywheel doesn't go in reverse; it just stalls during a bear market, and it kicks into gear when you're in a bull market. And the Stretch basically just helps it and has significant
Well,
advantage.
it does go in reverse in terms of market sentiment.
Right, but it won't. I mean,
Yeah, but they're not going to destroy value.
yeah, it's
Right.
the strategy's not going to implode.
Yes.
The premium's not going to go to
They're not going to
50.
issue
Yeah.
shares at a discount.
Yes, exactly. And Stretch has significant structural advantages to the convertible debt, and that's where they're trying to go. They're trying to shift from convertible debt to preferreds for the benefits of that. So with that, I'll wrap it up in saying I think a lot of the FUD, the fear, uncertainty, doubt is overblown. Um, and if you want to do any more digging, please refer to my Substack post.
Okay, terrific. And, drop a link to that in the chat.
Yep, done.
Done. Oh, perfect. Okay. So again, thanks, guys. That was terrific. And again, I said if anybody in the audience has a question, raise your hand, and we'll take them in the order received. And I will start. So it seems now that we're in, and to tell you, I had not heard the story, but you guys talked about this transition or evolution, from a levered accumulation play to more of a some kind of capital structure formation company. I'm not even exactly sure how the right way to describe it. But that's obviously that is a dramatically different story. What is the market thinking of that? I'm assume that there's a lot of confusion around that, and how do you think that works itself out over time? And Lance, I'll start with you.
Thanks. Yeah, Lou. I think that there is a lot of confusion around this point. And I think that the fact is that I do not believe that that strategy is in any way giving up on its mandate of being a significant accumulator of Bitcoin
Okay.
from here. I think that they view Stretch very much as a means to an end. I think that I think Jeff nailed it. I think that they absolutely are becoming a huge stockpile of Bitcoin that can collateralize a credit product. But the reason that they're doing that is so that they can basically raise money and buy a lot more Bitcoin. And I think that I would not expect them. I mean, in my opinion, right, 3 years from now, they're going to own a heck of a lot more big. At some point, they're going to own 1 million Bitcoin. I don't know if that's 1 year from now, it could be, or if it's 2 or 3 or 5, but I would be very surprised if, by the end of a reasonable couple of years here that they don't own a million Bitcoin.
Yeah, I mean that's what a million, yeah, is slightly lower than 5%, which I don't think the market would have too big of a problem with that in terms of the concentration. Jeff?
Yeah, we don't want to just agree with each other, Lance, but I have to say, I think you're probably right there. I think that strategy will keep buying Bitcoin. The let's say second derivative has decreased dramatically, right? So over time they'll be buying. They'll do periodic sales like the one from a couple of weeks ago. But I'd say at the end of every quarter they'll have more Bitcoin than they had at the start of the quarter, like as a base case, right? Um, and that's even when prices and MNAVs are here. So look, if the MNAV goes back to 1.5 to sort of where Mike was going, they'll probably start buying more aggressively, right? So then you'll end up with two legs or two levers or whatever you want to call it. And I'd say 1 million Bitcoin for strategy is next year. I think we can probably say it. Is it end of next year or mid? Don't know, but it's almost certainly next year.
I'm sorry, what's certainly next year?
When strategy own 1 million Bitcoin.
I'm sorry, I'm struggling to understand when they.
When strategy ends up owning more than 1 million Bitcoin,
Oh,
let's
more
say
than a
within.
million Bitcoin. Okay. Well, I'm sure that'll be a day they'll celebrate.
Sure.
And Michael?
Yes, I'm also looking forward to that day when they own more than 1 million Bitcoin. Um, yeah, I think they are in a position to keep growing. Not to agree too much, but they are also facing more competition, right? I think they've been through these drawdowns before, right? They're survivors. They've actually been in worse positions than they are today. During the first bear market in 2022, they had a loan. I think it was like some kind of bank loan that was basically collateralized by Bitcoin. So then they got called in and they had to raise the cash and pay it off. They survived. I think that's fresh in their memory, and that's partly why they're transitioning more to preferreds, to avoid those kind of situations. It'll take the market. Yeah, I think this is kind of growing pains, right? They've launched a new product in the middle of a bear market, and a lot of people who are buying it, I think were maybe a little bit misled, um, in that they were thinking stretch is going to stay at 100. People are using the words depegged, right? If someone says depegged, they haven't done their homework, right? They think it's like a stable coin or something. But a lot of people thought it was pegged, and that played a part in the precipitous sell-off down to 75 or so because people looping and leverage, and then when it broke, the dam just broke open and flooded everyone. So
I hadn't heard about that, but that makes a lot of sense.
yes, that was part of the issue with the initial sell-off. It was just too much leverage because people are digital credit. They thought it's always going to trade in the high 90s and you can't go lower. Now people are realizing that it's not going to always be in the high 90s, but perhaps over the long run, it'll be close to 100,
Okay.
right? In the long run.
Yeah.
So yeah, that's
Yeah. No, that's good. As an former equity analyst, I always come back to how do you value it? And Lance, again, the start. I think you're the only one actually following it, and I don't know, Michael, do you have a price target on it?
no
No.
formal
Okay.
price target. Yeah. I
Okay,
want to be
Lance, what's
compliance.
what's 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 your price target today, and kind of what are the major drivers of that?
Sure. So our price target is $260 per share. And we recognize obviously that in the world of traditional equities that might appear out of the context given that the stock is under 100. But I'll walk through how we get there in a second. But first, let me just say that, given the company's leverage to an underlying commodity that is itself extremely volatile, we think that the price target, which is a 1-year price target, is appropriate. In terms of how we get there, we actually we look at the value from two different directions. Number one, we look at how much Bitcoin that they own, and we then assume how much Bitcoin they're going to buy over the course of the coming year, and we make assumptions as to how we think they are going to finance that. And so we're projecting what we think their balance sheet's going to look like, how many shares we think they're going to have outstanding, what the interest rate will be on their blended borrowing costs, and so forth. And so we can basically establish a projected value of their Bitcoin holdings. And then to that, we then look at, well, they've got this, in addition to the Bitcoin that they have this engine which can go out and create incremental Bitcoin value, not by betting on whether Bitcoin goes up or down, but by virtue of the fact that they are able to increase the amount of Bitcoin that they own on a per share basis. And we think that engine, those treasury operations, are valuable just the same way that any company that generates any recurring, earning stream is valuable. So we take a 4x multiple on that engine, on that earning stream.
That's interesting. I was actually going to say, because those are generally pretty low multiple businesses.
Yeah, well, and so to be honest, we think that, look, it's really what you'd think is it would depend on the growth rate that you're expecting. And I mean, in the case of
That's
strategy,
fair.
and this is all in our, published research, so I'm not saying anything out of school here, but we have modeled the company generating $8.9 billion of Bitcoin dollar gain this year, and then over $10 billion next year.
And by that's additional Bitcoin that they'll have on their balance sheet
That
on a
is
per share basis.
that is the value of the incremental Bitcoin that they will have that will come to them with zero incremental dilution to shareholders.
Right. Okay.
So it has nothing to do with the price of Bitcoin going up or down. So we would then, if we think, so basically we're valuing that stream of, $8 to $10 billion of income potential, and then we're adding to it what we think the Bitcoin itself is going to be worth, and that's what gets us to the 260.
And what's the total market cap at 260?
The total market cap at 260, well, it's an enterprise value of about 125 billion, and then we back out about 19 billion of preferred equity and convertible debt.
So if you think this is going to do, that business will do 8 billion and give it a 4 multiple, then it's about a quarter of all the value you're attributing to strategy, which is a big chunk of value that they're creating with this new,
That's right. Actually, I mean,
business.
You're thinking about it exactly the right way.
Okay, terrific. And so we've got a question from Mike Evron. Mike?
Hey guys, thanks, Lou. So I guess what really confuses me about strategy, and I don't think anybody really knows the answer to this question, but I'm hoping you guys will speculate for me. What the hell is their end game? There's only so long you can accumulate Bitcoin. At what point are they done, and what do they do then?
So Jeff, you want to start?
So obviously in other DATs, like Tom Lee has said, they're going to go to 5%. So that's Tom Lee's end goal for owning ETH. And then he's going to use that to get, staking yield of 3%. So in non-Bitcoin space, it's relatively simple what the end game is. I would think strategy gets to 5% and then maybe considers what to do next. Maybe 5% of total market is a reasonable number. Obviously they'll have the next challenge of continuing to increase BTC per share. So that's probably the long tail, I suppose. So if you keep using the credit product to increase BTC per share over time, that's probably the positive, right? And so you go into
they could do that, I guess, by buying shares back.
Well, exactly.
Yeah. Okay. Cool. Michael?
Yeah, that is a very interesting question. Because if you scale it out far enough, trees don't grow to the sky, roots don't grow to China. Like Bitcoin's not going to go up forever, right? Um, and so at some point, it's gonna, plateau. In which case, you can't have a flywheel. Um, even the way that digital credit structure, right? He says, oh, as long as Bitcoin goes up by 2.3% every year, right? I don't think that would work either if it was kind of flat forever, right? I mean, at some point it's not gonna take over the world. So I don't know if that's in like 5 years or 30 years or more. So I think, the end game, there's a lot of possibilities. It'd probably be a gradual process. They'd probably go through drawdowns where maybe, the growth of Bitcoin just isn't as much as it used to be. And this could be 20, 30 years out. Maybe Bitcoin's already at 1 million or more, and it's just not people
Maybe.
potential isn't there. Which would be a great thing if it was at 1 million, right? I think everyone here would love that.
Hopefully long before 20 years, but
Yeah.
but
Um, Yeah, and I think when you've got that much Bitcoin, you've got over 5%, maybe at that time there's 6 or 7. There's just a lot of things you can do with that kind of capital and that kind of money. So I think that'll be a very good problem to have.
Can you
cool.
can you give me an example of what you can do with that kind of pile of Bitcoin?
Buy a few private islands, retire. But I know what you mean, like how could they benefit the shareholders? Um, you know what? Maybe they just return the Bitcoin, right? They just sell it.
So if I can just jump in, I
Yeah.
think this is a fascinating question, and it's one that we've actually spent a lot of time thinking about. Our long-term industry model reflects what we call two distinct phases: the accumulation phase, which we're currently in, and a subsequent operating phase. Now, I call them two distinct phases, but certainly we expect that there's going to be a lot of overlap here. But the accumulation phase, it represents the period during which all of these public Bitcoin treasury companies may reasonably expect to focus their Bitcoin treasury efforts predominantly, if not exclusively, on increasing Bitcoin per share. We think that this is going to persist, this accumulation phase, for at least the next 10 years. We could be wrong, but that's what we think. During this period, we think treasury activity will remain cyclical, and there's going to be periods of greater or lesser enthusiasm that lead to greater or lesser access to capital relative to access to Bitcoin. So it is not going to be the case, in my view, that every year in this accumulation phase is going to look the same, right? And you're seeing that now, and you've seen that over the past few years. But eventually, this accumulation phase will give way, we believe, to an operating phase during which the public Bitcoin treasuries will be focusing their Bitcoin treasury efforts predominantly on increasing Bitcoin per share via provision of goods and services backed by, based on, and or denominated in Bitcoin. And your question, what might these goods and services look like? And we base this on conversations that we've had with executives throughout the space, as well as the broader Bitcoin ecosystem. But we see, a digital version of traditional financial products and services, like, for example, Bitcoin-based loans, Bitcoin-based investments, Bitcoin custody services, each on both retail and wholesale bases. Those are probably the most obvious. Quite frankly, I've never considered myself to be a visionary. So I'm certain that the actual applications, I mean, I wish I could tell you that I saw Uber coming at the advent of the internet. I did not. So I'm certain that there are going to be unique applications that are much more interesting than the ones that I just listed. But the point is that we're heading toward, in our view, an economy that is based increasingly on digital capital. In an economy that is based increasingly on digital capital, you need digital capital to be active in that economy, to be a capitalist. So I guess what I'm saying is I think that the biggest holders of Bitcoin become the new banks in this new world. I don't think this happens overnight. I think this is a very gradual, development. But again, it's very similar, in fact, to the way that, the Bank of England got started with a charter to basically buy gold on credit and then they sold shares in that, and then ultimately they became the biggest bank, in the world for a time. And so, will that happen to Strategy? Will that happen to 21? Will that happen to MetaPlanet in Japan? I think it's possible.
Mike, get your question answered?
Yeah, very much so. Thank you.
Cool. Thanks for the question, Mike. Sandeep?
Thank you. My question, I guess, is a two-part question for the panel. Number one, do you see evidence of or believe there's potentially a capital rotation that has taken place of late from Stretch into SATA when we think about those two perpetual preferred vehicles? So that's the first part of the question. And then the second is just building on the theme of MNAVs, being above one or at or slightly below one. Is your general view that just as the Bitcoin price cycle goes up, we would expect to continue to see, as we saw last cycle, MNAVs expanding, and vice versa as the Bitcoin price contracts.
So, Jeff, you want to start?
Yeah, I might go for the second question and leave the Stretch one to others. But I think yes, it remains highly probable that there is positive correlation between MNAVs and price trajectory. Again, all of the benefits are much more obvious when price is going up, like Mike's idea of getting leverage version of Bitcoin, etc. So, and I think that's true across pretty much all assets that have DATs, at least sizable DATs, let's say. So I think in the next cycle, the one difference might be that you'll have DAT winners and losers on an MNAV basis. So let's say 1 or 2 or 3 in BTC, 2 in ETH, in Solana maybe 1 or 2. But I think it's highly likely there is correlation, yes.
Okay, thanks, Jeff. Michael?
Right. So I'll kind of like Jeff will go with the second question first. Yeah, so I think the premium, the MNAV premium is the fuel that spins the flywheel. And the primary value behind the premium, the reason why someone would pay above the value of the Bitcoin holdings to get a share, part of that is the belief that they will get more Bitcoin per share in the future. But also it's for leverage. And that really becomes valuable during a bull market, right? So right now the flywheel's kind of stalled, MNAV's won. But once Bitcoin starts doing better, you'll see the whole process kick in. I've noticed that SATA has been trading above Stretch, which personally I found quite interesting, especially given what I was talking about, the fact that I think there's many reasons why it shouldn't, right? And so when the market goes against you like that, you have to just remain humble and stay open to different ideas. But Strategy, it's been around longer than the competitor. It's been through drawdowns, and it's larger. It's got a moat. And I think part of that could potentially be just the noise and the fear. There's a lot of posts on and podcasts spouting stuff. So I think it could maybe be a buying opportunity.
Okay. Thanks. Lance?
Sure. So, well, certainly I think there's no question. If you look historically, right, we've already seen a couple of these cycles with MNAV, right, where it's gone up and then it's gone down and it's gone up and now it's gone down. So, and our, published view is that it's going to go up and down, again and again and again. It is not, in my opinion, likely to stay down, but it is also not likely to stay back at 1 or any other number. It's going to be it's going to be cyclical, and that's okay, because if you go back and look at it, actually, so MicroStrategy, and I think maybe it was Mike that alluded to this earlier, but MicroStrategy at the time, as it was known then, spent most of the back half of 2022 with a negative premium at a discount, and yet they still managed to increase their Bitcoin holdings on a per share basis by nearly 2%. So again, this idea that Bitcoin or that Strategy, is dead unless there's a premium it's just not supported by the facts, and it's not supported by, reasoned logic either. I would also point out that, if you think about we think about it, there's intrinsic reasons why a premium should exist, right? And it's not a greater fool's theory. You don't need a premium to beget a premium. Certainly the flywheel is real, but even if there were no flywheel, if nothing else worked, you should still have a premium, in our view, intrinsically, for a couple of reasons. And it depends on what you're comparing it to. So I'm going to attack this from a couple of different ways. Number one, if you're comparing it, and I'll be quick here, to holding spot Bitcoin, obviously, strategy is going to trade at a premium because it's so much easier, right? And nobody virtually institutional, and again, I'm focused on an institutional audience, not retail. Institutions don't want to have to worry about where they put their keys, and so forth, and they're just not going to do that. So clearly there's a premium relative to the actual commodity. Well, what about the ETPs, right? I mean, that solves the problem. Sure, that does. However, with an ETP, you're locked into owning not more Bitcoin per share over time, but by virtue of paying fees, you're locked into owning less, right? So I can guarantee you, this is actually, I'm not supposed to use the G word in my line of work, but just looking at the contracts, when you buy a Bitcoin ETP, you are contractually promised that you will own less Bitcoin per share in 20 years' time. About 5%. Now, 5% over 20 years may not sound like a big deal, but it's something. And I'm not saying that it justifies a huge premium, but it does justify a small premium. The other thing that justifies premium is this, and again, my colleagues have mentioned this as well, the ability not just to use leverage, but to borrow on incredibly attractive rates and terms, right? Very few of us have the ability to issue convertible bonds. I do not, right? I can go out and I can borrow against my house.
Not yet.
Not yet. That's a good point. But, and even fewer of us still, I mean, if you think about it, strategy with this preferred stock that they've sold, and they've sold $15.5 billion of it. This is perpetual for preferred shares. So basically this is people giving them money, and strategy is promising that they will never repay you. They'll pay you dividend, but it's like $15.5 billion, and I promise I'll never pay you back. And so, if you can do that, then you too should trade at a premium. But that ability to put that, and again, this is all in the context, you have to believe that Bitcoin is worth more 5 years from now than it's worth today. If you don't think, if you're not sure about that, or if you're wavering on that, then you should be running away from strategy. Right. But for those of us who think that Bitcoin is the future, you get it.
Yeah. Okay. Well, look, this has been awesome. Thanks, Lance. Thanks, Jeff. Thanks, Michael. Thanks, everybody who showed up. This will be up on YouTube on the replay shortly. Go Bitcoin.
Thank you, Lou. That was good stuff. Appreciate you guys.
See you, Sheldon.